started, I'll give you a little background. My name is Laura Starker. My teammate over there is Caitlin Kipp. I have originated mortgages for about 20 years. Creating this presentation, really not the easiest thing to do. Mortgages are not complicated, but there are some nuances to trying to get a borrower into a home. I've originated for 20 years. Caitlin is my teammate. Should I start again? Okay, go for it.
You good?
Yes.
Okay. So Caitlin has originated with me for 5 years. We do work for a company. It's called Guaranteed Rate. We are located on Columbia Street in Hudson. And we're going to kind of do just the basic. This is not a mortgage specific to Guaranteed Rate. It's just the basic mortgage process. So the agenda for today is what is a pre-approval, an initial self-assessment, what is a down payment, what are closing costs, what are prepaids, what are seller's concessions, what documents do you need for a pre-approval and for the mortgage, important reminders, mortgage products, and the very end is who is involved in the mortgage process. I'm going to ask you, I gave you, you have your presentation. If you have questions, because I have a squirrel brain and I'm a Pisces and I can veer off direction, we'll be here till midnight. Let me get through the presentation. Feel free to write down any question that you may have and I will do my best to answer it. So what is a pre-approval? A mortgage pre-approval is the formal process that an originator evaluates your financial situation to see how much money a bank is willing to lend you. What it involves is reviewing your income, looking at your credit score, looking at the debts that are on a credit report, and also your financial assets, like your bank statements. The pre-approval process means you apply with the lender. A lot of us do digital applications, so you're going to do a digital application. We do a credit check. Traditionally, a lot of lenders have moved towards soft credit pulls, which means there's no hard hit to your credit. The reason being is, as we continue to have like a housing shortage, some of my borrowers are looking for homes for a year, 2 years. There's no real point to hitting someone's credit. The beginning process is we do a soft credit pull. And then once we talk with you about a purchase price range, a monthly mortgage payment, we will issue a pre-approval letter. Why do real estate agents require a pre-approval letter, or do they want a pre-approval letter? For one instance, if you would like to see a home, right before I came here, I had a real estate agent who said, I know you're going to your presentation. I'm trying to get my client in to see this home. Would you send me a pre-approval letter? The pre-approval letter signals to your agent and the listing agent that you have been pre-qualified with a lender. It also shows that you're serious, you took that step, and your pre-approval letter states your purchase price range, your loan product, as well as your down payment. Be mindful, a pre-approval letter is not a formal guarantee that you're going to get a mortgage, and we'll go through why on the slides. So the initial self-assessment, the first question that I ask any borrower is, what monthly mortgage payment do you feel comfortable making? When I talk mortgage payment, I'm talking principal, interest, taxes, school, property, possibly village, and homeowner's insurance. It's called a PITI payment, P-I-T-I. Some borrowers say $15,000, other borrowers say $2,000, other borrowers say $1,000. I always follow it up with, you want including taxes and homeowner's insurance, because that's going to dictate to me really what your purchase price range is. The next question that I ask, what is your credit? Any idea what you're doing with your credit? Do you know your credit score? There are 3 credit bureaus, TransUnion, Experian, and Equifax. If you apply for a car loan, if you apply for a credit card, all of those credit repositories are pulling Experian. It's called, all lenders have to do a tri-merge credit report. We're pulling from all 3. And so a lot of people, when I pull credit, I'll say, oh, your credit score is 680. Oh, that's interesting. My Credit Karma says that I'm at 770. Credit Karma is a great credit repository app. Like it's great for monitoring. However, Credit Karma, and if you have like a Capital One credit card, you get your statement in the mail and they're like, we love you. You have a 770 credit score. They're only monitoring your credit cards and what you're doing with your credit cards. Think about this. You're asking a lender to give you $200,000, $300,000, whatever your purchase price range is. That's a lot of money. So they will scrutinize the credit repositories that lenders use. We're going to scrutinize you harder than Credit Karma. Be mindful. A lot of people ask me this. I get it all the time. So let's say you're applying for a mortgage. You have someone who else is applying with you. The system's going to do a soft credit pull on you, and I'm going to get your 3 scores. I'm going to look at your middle score. The person who you're applying with, the system's also going to pull 3 scores. I'm going to look at that middle score. Whoever has the lowest middle score is the score that all lenders use, and that's going to dictate what your interest rate is. It is true, the higher the credit score, the better the interest rate. So a lot of people say, well, wait a minute, what if I add a cosigner? Wait a minute. Credit score is credit score. We always have to go off of the lower, whoever's got the lowest, the mid lowest score. And the last question that we always ask, Caitlin and I, is what money do you have to work with? What money do you have for down payment, closing? And then if somebody says, I have $10,000, I have $5,000, I have $50,000, I always say to people, where is it? Is it in Bank of America, Bank of Greene County? Are you getting gift funds? All of that. So we're really asking a lot of questions. Down payment. A down payment is the initial payment made toward the purchase of a home. It's usually the percentage of the home purchase price, 5% down, 3% down, and each loan product has a different down payment requirement. So a lot of times people say, I don't have 20%. You don't have to put down 20%. Closing costs. Everybody has heard the term closing costs. I will let you know that in New York, guess what? We are one of the highest states for closing costs. The reason being is we are a state that requires attorneys, and that's like unheard of for other states. Other states are like, what? Title isn't doing everything? I got to hire an attorney? Yeah, you do. And as the buyer, you're paying for your attorney, and guess what? You're paying for your lender's attorney. So there's attorney fees, there's an appraisal fee, there's title insurance, there's New York State mortgage tax. The 2 biggest hits, you're shaking your head, you're like, New York. The 2 biggest hits in your closing costs are title and New York State mortgage tax. New York State mortgage tax, a lot of lenders will leave it off the loan estimate. It's going to get put on at the end. It's an absolute requirement by New York. Every county has a specific every county has a specific tax. Columbia County, 1% of the loan amount. Greene County, 1% of the loan amount. Ulster County, Dutchess County, 0.80 of the loan amount. If you get further into New York, like Kings County, I think it's like 2% or 3%. So you have to just watch your county for your New York State mortgage tax. Prepaids. Now this is something where people are like, I don't even know what that is. Prepaids are upfront fees that we're going to collect at closing to help you cover future expenses. The first thing that you're going to see when you go to closing, and there's called a closing disclosure, or when you're going through the mortgage application, it's on your loan estimate, is something called prepaid interest. So let's use a closing date of February 25th. We're going to use it for this example through the whole class. February 25th, you're closing on your loan. Let's say there's 30 days in February. I know there's not, but let's use it for this example. There's 30 days in February. Prepaid interest covers every lender from the 25th to the 30th. So you're going to get charged 5 days of prepaid interest. Your first mortgage payment, if you close in February, is due April 1st. Why? Because you pay your mortgage in arrears. They allow you to live in the house for the month of March. April 1st, they go, you lived in here for a month, pay your mortgage. So the prepaid interest covers the lender while we're waiting for you to make the mortgage payment. Homeowners insurance. Homeowners, I had a borrower say to me, I don't want that. She didn't want to pay the fee. She was like, I don't want that. You have to pay for homeowners insurance. I will let you know that homeowners insurance, due to everything going on with all these wildfires and everything doing, you are seeing homeowners insurance premiums go up across the board. Homeowners insurance, if you're closing on February 25th, my processor will say to you, bind your coverage for a year, February 26th of 2025 to February 26th of 2026. You're going to bind it for a year. As you make your mortgage payment every month, you're going to contribute towards an escrow account. An escrow account is a savings account that when your bills come due, school, property, and homeowners, the homeowners insurance agency is going to mail it to your mortgage company. Your mortgage company is going to pull it from your escrow account, and boom, the bill is paid. So at closing, the bank attorney is going to say, okay, hold on a second. School tax bill is going to come out in September. I need some seed money. I need to start to fund this escrow because you're making a mortgage payment in April. You're going to contribute towards the escrow. So an escrow deposit is the beginning of a savings account. And the last thing that literally confuses everyone is paying the seller back for taxes that they have paid out. So if you're closing on at the end of February, we're in the month of January. Whether you have a mortgage or not, if you own a home, you have to make your property tax bill. It's due this month. So if the seller says, oh, okay, I paid that whole bill, I paid that for a year, your attorney is going to say, we have to give some money back to this person. We have to give 10 months back or whatever. Attorneys do things actually to the actual day, so I'm just kind of ballparking it. But it's called prepaids. So what does all this look like? Here's an example. We like Annie. Annie is purchasing a $200,000 home. Annie's going into FHA. A lot of people consider FHA first-time home buyer. Her down payment is $7,000, 3.5%. That's an FHA requirement. Her estimated closing costs for this example are $8,000. Her estimated prepaids are $5,300. That brings her total out of pocket to $20,300. So Annie then said, wait a minute, I have $9,000. I don't have $20,000. You mean I can't buy a home? You can. We're going to show you how we're going to do that. We're going to try to implement a seller's concession. This is Caitlin's favorite. I got to do it. This is Caitlin's favorite graphic. What is a seller's concession? Each loan program allows you to roll in a portion of your closing costs and prepaids. So this is really crucial because a lot of real estate agents do get confused and say, you mean my seller's paying for her closing costs? No, that's not allowed. What you can do is, how much money do you have to part with? That amount will go towards your purchase price. So here's your example. Let's go back to Annie. She wants to put an offer in on a $200,000 home. She's already said, I don't have $20,000. What am I doing? Well, FHA's minimum down payment is $7,000, 3.5%. That's an FHA requirement. FHA will allow a 6% seller's concession, which is $12,000. So what happens is she can finance in up to $12,000. So on your pre-approval letter, and where your real estate agent needs to know this because they have to present the correct offer, they will say to the real estate agent will read the letter and say, oh, she needs a $12,000 seller's concession. So the purchase price is really $212,000. Yes, the purchase price is $212,000. In the letter, it says the seller's going to net $200,000, which means at the closing table, they will get a check for $200,000. The 12 is taking Annie from $20,300 to $8,300. Whoa, perfect. She's like, I have my 9, I have to use 83, I don't have to come up with the rest. It's called a seller's concession. Why is it called a seller's concession? Because the seller has to agree to allow you to roll in your closing costs. They have to, because what's happening is all your contracts and everything on paper is you're going to see a purchase price of $212,000. Then in the contract, the attorneys write a $12,000 concession a net to seller of 200. You have to be mindful that the house has to appraise for 212, okay? Necessary documents, what do we need? If you are self-employed, every lender is required to collect 2 years of tax returns. We're going to look at your Schedule C. We take it a step further, that we make sure if you have a DBA, you have to think like underwriters Google people and Google businesses all the time. So we are collecting 2 years' most recent federal tax returns. If you have corporate returns, we need those as well. If you are paid W-2, we are getting 2 years of W-2s and 30 days of pay stubs. Pay stubs are, if you're paid weekly, it is 4. If you're bi-monthly or bi-weekly or bi-monthly, we need 2. Bank statements. I'm an originator. I do not collect bank statements up front. I really don't. I will do it once you're through the process and I get them. But I always say, all right, Annie, $9,000, where is it? It's in the Bank of Greene County. How long has it been there? I've been saving it. I've had it for a couple of months. Perfect. When she is going into formal underwriting, I'm going to get 2 months of bank statements. And when we write all pages, we mean all pages. If page 4 is blank, and you have to provide page 4. People go, it's blank. We don't care. We have a guideline that we have to follow. You have to look at if Bank of America says 1 of 4, and we don't have 4, the processor is going to turn right around and say, send me page 4. And do me a favor, to make my life easier, I'm going to be 55, I'm old. Please do not screenshot things to me. If you screenshots are hard, and the thing about it is we really do ask people, could you PDF? PDF makes our life a lot easier, trust me. Important reminders, this is huge. Throughout the mortgage process, even if you've been looking for a year, or you found a house and you're mid, like you're going through and you're almost to closing, don't change jobs. And I'm all about people bettering themselves. If you do have to change jobs, or if you're like, hey, I heard this really great opportunity, you are to contact your mortgage person immediately. Because if your salary going to hourly, that could be a problem. If your salary going to hourly and the hours aren't guaranteed, that's a huge problem. You now have all of a sudden stopped the process. I'm hyperventilating, you're hyperventilating, and your real estate agent is yelling at me, and I'm like, what are you yelling at me for? They switched jobs. So just make sure if you have hey, I heard of a great opportunity. What we have going on right now is a lot with traveling nurses, and that's tough. It really is. So those contracts that traveling nurses are signing are tough. Large purchases. Please do not buy furniture for a house that you do not own. Don't do it, because one thing that people don't realize is when you've applied for a mortgage and you're in the mortgage process, all lenders are monitoring you all. So all of a sudden, I'll get up in the morning and I'll be like, who bought what? Because we get an alert. If you buy a car, if you buy furniture, and all of a sudden we have a new debt, we have to hit you with that liability. You could potentially not qualify. Have I had people buy a new car, and have I had people say, return it? Absolutely. Have I had people say, you got to pay it off? Absolutely. Or I'm scrambling to find a cosigner because you now don't qualify for that new purchase given your income. If you are receiving a gift from a family member, lots of families do it. Hey, I'll give you $5,000. Hey, I'll give you $10,000. There are guidelines that we have to follow. It's called proof of donorability. So if you have a family member who says they're going to give you $5,000, guess what we say? Show us, family member, that you have it. I'm not showing you my bank account. Well, you have to do something. You can't just deposit something. So if you're getting a gift from a family member, just let us know. Co-signing for a loan. Co-signing for a loan means you're obligated on that debt 100%, just with the other person. So I have a lot of people who say, what do you mean? I just co-signed. You're obligated. It's on your credit report. If they don't pay it, you're obligated to pay it, which leads me to, if you do co-sign, like I co-signed for my niece, for her wedding, which she's now divorced, don't even get me started. And I said to her, I don't mind doing this, I really don't mind doing this, but I am a mortgage person and I do have to pass a financial fitness test every year. Caitlin and I have to get fingerprinted through the FBI. Why, we don't know. But I said to her, if you for any reason cannot make the loan payment, I'm not getting the statement, I don't know whether you've paid it, reach out to me immediately. I will not yell, I will not do anything, I will just pay it and we will go on with our lives, because that's going to hit my credit. And then I'm going to be saying the guaranteed rate, I just co-signed for a loan. Large deposits. The definition of large deposit based on loan program does vary, and Fannie and Freddie do change their guideline. So I can't really answer you the question of what's a large deposit. Just be mindful that my processor and my underwriter, they do look at bank statements. They're going to see how often you're going to McDonald's. They're going to see, and they do have the right to say, I see that you're writing the same payment to the same person. What is that? So people get annoyed. Why are you asking me? Because we are making sure that you are going to make the mortgage payment, and that could be a potential risk. Cash, for some reason, in Columbia and Greene County, cash is in a lot of people's homes. I don't know where they're getting it. There's a lot of safes in these houses with a lot of cash. If you have cash, you need to tell your originator where it came from. Because the guideline says nail technicians or wait staff, hair, anybody who's like, hey, I get tips. I just take my tips and I throw it in my safe. That's plausible. But if you're an accountant and you're doing whatever and we can't source where the cash came from, that's a problem. Okay? So we're going to talk about the different loan products. There are first-time buyers, there's rural, there's the veteran loan. But the one that I originate the most is FHA. FHA is, a lot of people go, that's the first-time home buyer product. No, it's just backed by the Federal Housing Administration, but it is really good for first-time home buyers because they do allow a lower FICO score. And they also have a lower down payment. FHA allows a 3.5%. Absolutely 3.5%. They will not allow a borrower to close if you're not coming to the table with that. However, if it's coming from a gift, FHA allows that. So if a borrower says, I don't have it, but I'm getting it from my family, you're fine, FHA. FHA allows for a 6% seller's concession. They also allow, they will go as low as 500 credit score. However, if you're in the 500 to 600, you are not putting 3.5% down. That file will never get approved. So usually when borrowers have the lower credit score, they're putting more down. And you have to show asset. It's anybody in the 500 to 600, even like 500 to 620, it's a higher risk to the lender. Borrowers with no credit history. Now we've pulled credit, nothing shows up. FHA allows that, but they say you need to get a rental history, you need to pull a cell phone bill, you need to pull car insurance. I've even tracked people's gym memberships. I've been desperate sometimes. I'm like, can I use Planet Fitness? As long as you can show a payment history, you're fine. FHA has loan limits. So in Columbia and Greene County, the single family is 524, 225. This documentation is all online. You can Google FHA loan limit, put in Nassau County, put in Rensselaer County, put in Albany County. It is what it is. It's going to tell you what it is. A 2-unit is 671, 200. I will let you know that every year FHA has been raising their loan limits because the purchase price ranges have been going up. So they're trying to keep competitive. It is an absolute for FHA. FHA will go up to 4 units. So if you see a 4-unit and you're going to live in one of them, my advice to you is buy it because you're going to make money on it. And you can, and FHA takes it a step further that says, we don't care whether you live in it. They want you to live in it for 6 months up to a year, then you can move on. You cannot have 2 FHA mortgages at one time. The only way you can do it is if the houses are 100 miles apart. That's an FHA guideline. FHA is primary residence, and they will allow you to max your DTI, which we will get into, which is debt to income, up to 57. If you're in a FICO below 620, you're not getting a 57 DTI. We're going to pull that back. For us, our minimum FICO is 580.
Are you finding a lot of issues with income versus what the houses are costing now when you're approving people?
What we're finding with the 20-year-olds, people have 50 million W-2s and 50 million jobs, and that makes it really challenging because what I don't think everyone realizes, when you have to do a 2-year history, we're soliciting the IRS for borrowers' tax transcripts. If we're missing W-2s or we're missing, hey, all of a sudden this was the income that was claimed, we have to now take a step back and grab all those W-2s and do all that verification of employment. I mean, it's just a generational thing. Like, I've originated for 20 years. This is my second mortgage company, but I have people, like one person gave me 7 W-2s in a year time frame. That was a challenge. So you have to just really, one of the things that I do is I take a step back, especially when real estate agents want a pre-approval like right away. And sometimes I'll say, I can't. I need, like, it takes time. So you have to just make sure that you're really doing the due diligence. And what I've even started to do was I will email my processor and I will say, send an authorization form. I can't figure out this income. I can't get a handle on really what's going on. And we will reach out to the employer directly. Therefore, I know that I'm hitting guideline. Yeah. USDA is the next first-time home buyer. This is your 0 down payment. USDA is backed by the Department of Agriculture. Definitely a harder loan to originate. USDA has geographical limits. So, for instance, USDA is rural, so they want rural. Believe it or not, USDA thinks Hudson, New York is rural. All of Columbia County, all of Greene County are zoned USDA property eligible. If you go into Albany and you go into Rensselaer, the city of Albany, forget it. There is a map. So here's and it's on your thing. This is all of your government stuff is pretty much online, but there is a map that if you said, hey, you know what, is this USDA eligible? Literally Google USDA eligibility map. When you go into the USDA website, just click accept, and then you can type in any property address. Make sure you do the city and the state though, and it'll tell you. There are 2 different USDA loans. There's the USDA guaranteed, which is backed by the USDA, but funded by a private lender. That's what I am, and that's what Caitlin is. Or there's the USDA direct. The USDA direct is for very low income applicants, and they apply directly with the USDA. No lender can be involved, none of it. I will say that their interest rates are low. I believe they're in the high 4s, which we're now in the high 6s. But every year, if you are a USDA direct applicant, every year you do have to upload your W-2s. They do monitor people's income. They are a true USDA, whether it's guaranteed or direct, is a true 0 down payment program. This is the URL. There are income limits, and when they talk about income, it's every single person living in that house. So a lot of times you will hear an originator say, oh, do you have somebody, is it you and someone else living in the house? Oh yeah, well, we're not going to use it. Technically, that person committed mortgage fraud because USDA says whoever is in the house and earning a wage, anyone who's 18, 16, 14, you're in the house, that income technically needs to be in for qualifying income. It's called qualifying income. USDA, because it is an income qualifying, when I say it's the hardest loan that I originate, USDA will scrutinize the hell out of a bank statement. Like, they will. We are a day and age of Venmo and PayPal. Anyone who has a Venmo deposit, guess what you're doing? You're sending me the whole transaction history, who paid you what, and what was it for. Even the $5 or the $10 for pizza. You have to understand with this program, because it's very strict income eligibility, they're looking at all the income. They do allow, so the income limit is 115 below the area median. If you want to know what an area median income is for each property, you can Google it. It's again another map. And they have they, every once in a while, they really want their borrowers out of 41 debt to income. That's low. It's low. They, every once in a while, will allow us to go up to 45, but you do have to have compensating factors. The minimum credit score for USDA is 640. That's their hard guideline. Any veterans in the house? Look at you. Awesome. So this is backed by the United States, or this is backed by the Department of Veteran Affairs. It is open to any U.S. veterans, active duty service members, and certain surviving spouses. It's actually a really great product. It is a zero down payment, very lenient, follows along the lines of the FHA. The one thing, they do allow a really good debt to income ratio higher up, but the fun part about the seller's concession on VA, that veteran can basically get into that house with absolutely no money. They allow all closing costs, any points to buy the interest rate down, and up to 4% of the purchase price to go towards prepaids. The hard part about that when I originate, and we as a company, we waive all of our lender fees for any of our veterans. The hard part in that is if you have a really high seller's concession, $15,000, $20,000, because you're going to really come in with no money out of pocket, the house has to appraise for that higher amount. That can make real estate agents like a little like, I don't know if it's going to appraise that high. The other thing is with the Veterans Administration or the VA loan, they have their own appraisal rotation, and they're all angry appraisers, just so you know. They're angry, like we've gotten yelled at by them. And you do have to do, just as an aside on a home inspection, you do have to do a termite. It's required in Columbia Green and up north. Yeah, that's a VA requirement. Termite and the water test. They want the full water test. The whole Mamba Jamba, like $110 water test. Conventional. So this is the loan that's been around forever. It's not insured by any government. It's backed by Fannie and Freddie, and it's open to all private lenders, which is what we are. Fannie and Freddie, if you don't know, they're the governing bodies of the mortgage industry. There are loan limits, and we kind of are just citing Columbia and Green. It's $800 and $6,500. That's your loan limit. That is incrementally going up every year as well. Down payment minimum is 5%. You can do up to 20. You can do up to 30. You can do whatever you want. Conventional, actually, to rival FHA, came out with a 3% product. It's called the Home Ready and or the Home Possible, depending on whether you're going Fannie Freddie. That's an income limit thing as well. Credit scores, we always say a minimum of 620. Am I getting a borrower that has a credit score of 620 with 5% down approved? No. No, never in a million years. One is the borrower is going to take a bath on the interest rate at 620. Usually if someone's going 620, they're putting a lot down and have assets. The debt to income ratio, hands down, is stuck at 49, and they will only do a 3% seller's concession. Debt to income ratio, what does this mean? So this is crucial in our world. Like Caitlin and I, we talk to our processors, our underwriters, and the first words out of anybody's mouth is, what's their DTI? What's the debt to income ratio? In the process, the debt to income ratio is the key metric all lenders, all of them, use to assess a borrower's ability to repay a loan. It compares your monthly debt. So think about this. We only look at the debt on your credit report and if you're paying alimony or child support. And so don't lie to us if you are paying alimony or child support, it's going to come out. It always comes out because it's usually on your credit report in some fashion. And we look at the potential mortgage payment, and then we divide it by your gross monthly income. One of the reasons why we always ask for W-2s, we want that gross income. So it's the total monthly debt divided by your gross monthly income. It's called DTI. Who's involved in the mortgage process? So this is kind of key because there's a lot of people. And the first two bullets are my all-star favorites. Your real estate agent. I call a real estate agent your cheerleader and your therapist. because the person you're going to go to complain, but they're also going to be the person that you go to hype you up, to get you excited, and they get you in to show you houses. They can, connect with a real estate agent. They're going to be able to show you everything. Their job is to talk to the listing agent. Their job is to get you into the home. Their job is to walk around with you. You can be honest with them. I hate the wallpaper. I can't tell if my couch will fit here. Their other job is, next question is, should I put an offer in? What should I put an offer in? What do you think? The whole 9 yards. Once you have an accepted offer, they're helping you schedule your home inspection. They're talking with us. They're talking with you. They're talking with the attorney. They're making sure you're moving along. So find your cheerleader, like your cheerleader, be kind to your cheerleader. There you go. The second most important bullet point is your home inspector. I always say to a lot of people, if you're going to spend $200,000 on a home, you're not going to get it inspected. When you're looking at the home, you're trying to determine, can I fit my bed in here? Can I fit my bed and my dresser in here? The home inspector is going up in the attic, going down in the crawl space, walking around. He's going to go up on the roof, tell you how old the roof is, when he thinks you might need to repair the roof. Hey, there looks like there was a leak in the basement. Hey, this outlet doesn't look correct. Their job is to tell you the immediate repairs that are needed, as well as future repairs. Everybody people who know me know, I've had 2 houses. 2 things I could never be a real estate agent. Why? I will never go in an attic. You wanna know why? Because in horror movies, you get killed in the attic. And I will never go in a basement, because in horror movies, you get killed in the basement. So I could never do that. I've never been in my attic. Never been. People are like, I've never been in my attic. I had 2 houses, but I've had a home inspector go in my attic, and I had the home inspector tell me everything that they saw. It's crucial. I'm not going in any attic or in any crawl space. Like, ugh. Then you have an attorney. An attorney's job is to represent you legally, look at your contract, order title. You have a loan originator. That's me. That's Caitlin. Our job is to look at your credit worthiness, collect the upfront documents. Second job is a processor. The processor's job is to double check my work. And you need that, because Caitlin and I, think about it, all day long we're working with borrowers, but the phone is ringing, the emails are going off. I'm stopping an application, starting an application, stopping an application, starting an application. I missed I don't know what happened. So the processor's job is to double check everything that we submitted and ask you for more documentation. The processor's job is also to get a written verification of employment. I cannot be involved in verifying anyone's employment. No originator can. I'm 100% commissioned, and they look at it like I'm trying to skew things. So my processor will order a written verification of employment, and she will also order the appraisal. An appraiser's job is very different than a home inspector. So a lot of people will say, well, I'm getting the property appraised. Why do I need a home inspection? Home appraiser's job is not going to tell you what repairs you need, everything. They're going to determine the fair market value. Is the house worth what you're paying for it? And does it meet mortgage guideline? And the last person that you will never talk to, but that I talk to and I argue with, is the underwriter. The underwriter's job is to assess all the information that has been brought in front of them and determine, are they willing to give you a mortgage? And if they do, they're going to issue you something called a conditional commitment. A conditional commitment means, we like you. We're going to close on this house. However, you need to provide another pay stub. You're getting gift funds. We need to source the gift funds. We don't have the appraisal. We're waiting on the appraisal. We don't have title. We're waiting on title. It's called a conditional commitment. If an underwriter, and we get it a lot, I will get a call from an underwriter who says, tell me what's going on with this file. And I do, and they're like, I'm not loving it. I'm going to suspend it. I would like you to get further documentation. And very rarely, because Caitlin and I do such a good job at very rarely our underwriters decline a loan. And traditionally, if a file is declined, it's because I had a borrower 2 days before closing quit his job and then said to me, I didn't think you were going to find out. We find out. You want to know why? we are required 24 to 48 hours before closing to verify that you're still at your job. So if you have any questions, this is, I can answer any questions. This is our contact information. It's on the back. If we do have an Instagram account for funny mortgage content, every once in a while, Caitlin and I do think we are pretty funny. If you would like to start the pre-approval process, you can scan the QR code. But does anybody have any mortgage questions?
Do you have any programs, or say an agent brings in someone who wants to get a loan and they're very close to being approved, like qualifying for one, but need a little work on things? Do you have programs that help people go from one point to the next?
Like credit?
Yeah.
I do a lot of because the one next class that we were thinking of doing is a credit class, but one is if they're close, then I'm going to tell them what to do. I'm not a big believer in people paying money. I'm really not a big believer in people paying money. Hey, I'm going to pay you every month. You're going to help me clean up my credit. That never happens. Those companies take your money and they're not cleaning up your credit. A lot of times what happens is those companies tell you not to pay your bills and then pay us and we will pay them, and that's not what occurs. So because I've done it for so long, and we also, a lot of lenders have the ability, it's called a what if scenario. So you can say, I can look at a credit report, log in, and I can say, well, what happens to the credit score if I pay this down? What happens to the credit score if I do this? The other thing is if you do have credit and you have a lot of credit card debt and you want to pay it down, do not pay those credit cards off. Don't pay them off, and don't close them. If you close them, your scores are going to tank. What I say to people is pay them down. Hey, $5,000, pay it down to $100. Let it ride. Just make the monthly payment. What you're doing is you've reduced your utilization to the credit bureaus, and they went, oh, we like you now. Okay, you've now become a proper, credit. The one thing that people do is with credit is they'll get a credit card and then they rack up hey, I have a $500 balance, going to Kohl's, and I'm charging $495. Wrong. If you have an liability or you get a new credit card, the one thing you should do is open it and use it, a small amount of it. Get gas, get groceries. Eggs are like what? However, $10 now? Get groceries. Don't charge anymore. Get the bill, pay it down. You will see your scores come up. You really will. If you know what I mean? Yeah. Well,
do you think it's important for people to know about that they might be asked to pay a 0.5% or 1%
To buy the interest rate down?
commission? Because I know
Oh.
the VA, they passed something that they will pay them now.
Oh, they did?
Yeah, that's something that never happened, right? In the VA. And
so so what Nicole is bringing up is if you haven't heard, and a lot of home buyers haven't because it's not your world, real estate agents get paid. I'm 100% commission based, but I'm the last one to get paid. So if your loan is closed on February 25th, your real estate agent is going to get paid on February 25th. Laura gets paid at the end of March. But real estate agents are commission based. In the past, when a house was listed, the seller would pay the commissions. And it would be decided upon, hey, I'm going to pay 5%, 6%. And the buyers really never got involved in that. Nobody really cared. It was coming off the selling side. There's been some lawsuits where sellers have said, I wasn't aware that this was happening, blah, 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 blah. And now what has happened is if I go to list my house, I might say to Dan, who's my agent, I'm only paying your commission, or I'm only going to give a certain amount. What we have to now say, then we do say to all of our buyers now, is when a buyer comes before us and they're going through the mortgage process, we will say, do you have to pay any portion of the commission? And it's the obligation of the real estate agent to have that conversation with the buyers. We have had a buyer who said to us, I don't know. And at the end of the day, it came about that she had to pay the real estate agent $10,000. She pitched a fit. And we were, and I were like, we removed ourselves from that. I'm like, whoa, this is between you and your real estate agent, because that's a huge violation. But at the end of the day, she then said, the agent jumped in and said, no, there's a miscommunication. She has to pay me $1,900. Still wasn't $10,000, but still wasn't appropriately explained to the buyer. So your real estate agent will discuss with you on a particular house if you have to help contribute towards their commission. They have bills to pay as well.
Yeah.
And that paper has to be presented to you
We
upon
do-
meeting each other. I mean, the agent is compelled by law.
From my understanding, I don't do real estate, but from my understanding, I believe you have to provide it to your clients up front, right? Right. So that's another part of what could be part of your closing costs is, hey, I really love this house. I have to pay 0.5% to my, 0.5% to my real estate agent. We're going, we'll sometimes do the quick math. What we'll do is we'll send an email to you and the agent and say, this is the number we're coming up with. Is that accurate? And we put it as part of your closing costs as well. You can, what you are seeing is the VA for the longest time would not allow, absolutely not allow any paying of commissions to be part of their seller's concession. And I'd have to get that guideline. You're saying they changed that ruling? Okay. So that's just kind of some food for thought.
The closing costs, like appraisal fees, title insurance, etc. Are there like typical like averages, like what's you're like not getting overcharged or under or?
No, the thing about, so the only thing that you can shop, all of your fees, like your third party, your title, your attorneys, that is what it is. As a borrower, you can shop a lender's origination fee, but the rest is all stuff that's mandated by New York. So you can shop home. That's a prepaid, but you can shop homeowners. Your tax bills are your tax bills. They're a matter of public record. But if you really want to compare lender to lender, you can look at origination fee. But the rest of your attorney's going to say, my fee's this. He will ballpark you on title charges because the title company is going to give him, once title is in, an actual invoice.
There's no typically it ranges around.
We get that question a lot. It's hard to, it depends. It's going to depend on your purchase price. It's going to depend on your loan amount because that's going to dictate your New York State mortgage tax. Because it depends on what county you're buying in. So if you're like if you're a $400,000 purchase price and your loan amount's $350, right out of the gate, your mortgage tax is $3,500. So it's hard to kind of ballpark. Yeah. Yeah. Any questions?
Yeah, I have one. For debt to income, the DTI, when it says total monthly debt, is that like what you get, are you talking about how much you're using on your credit cards, for example, or is it what you're getting as your final statement at the end of the month?
So this is so this is the thing about credit. When all credit, same thing with car loans, mortgages, credit cards, every repository like Capital One does one massive check-in once a month with the credit bureaus. So a lot of times when we do a soft credit pull at the beginning of the month, Capital One has chimed in for the month previous. So sometimes people will say, well, I paid that off. Why is that showing? It's not in real time. What we look at is for your total monthly debt, what is reporting on the credit report and what's the minimum payment? You can say to an underwriter, have I had borrowers where I'll say, hey, you would like to purchase this house and qualify for XYZ, you have to pay off your credit card or you have to pay it down. I always say to borrowers, don't jump the gun. I had one borrower who literally said to me, should I pay off all my debt? Before I could even answer, she started paying off all of her debt. And I was like, could I answer? Because what I say to people is, we can always tell underwriters what you're trying to do. Hey, you're getting a gift. Hey, they're going to pay off a car loan. Mom's going to pay off the car loan. Don't pay off the car loan until the underwriter has given the blessing that they're going to do the mortgage. It's called a prior to closing condition. Prior to closing, can you pay off the car loan? We're going to verify you paid it off. Yep. Yep.
for the prepaids, we're paying this other back for taxes. Does that mean there's a better, to not like avoid that, is a better time of year to try to close on a house or anything?
No, the only thing that you can do, and our lives are crazy, we call it month's end. So, and you'll hear it from attorneys too. A lot of and it's hard when you're buying. All refinances all go at the end of the month. When you're buying, you have to consider, you do have a seller. Like right now I have a domino effect. I'm clearing a borrower, her sellers are trying to buy, the people that are trying to buy. So what happens is sometimes closing dates are true and accurate in a contract. They're called on or around. But if you really want to save money, you want to try to close at the end of the month to save on the prepaid interest. You just sometimes can't if a seller says, hey, I got to close, people. It's February 5th that I'm closing. And you're like, wait, I want to close on February 28th. I don't want any prepaid interest. The seller, you can get a little bit of pushback, but if you do want to save money, it's really going to be in your prepaid interest. So you see our world, like sometimes I'll say that we get to the end of the month and I go home and I'm having a gin martini. I'm like, we made it through month's end. It's just the fast and furious of everybody trying to close. Yeah.
Another one is with job changes, you mentioned like things like switching from hourly to salary. So does that mean like a positive job change?
Positive job change is hourly to salary or hourly to hourly as long as it's guaranteed hours. If a borrower goes to variable hour, I'm per diem, I'm direct care, I'm a nurse, and you're variable. I work 38 hours one week, 25 hours another week, 50 hours one week. We have to average 2 years. So if somebody switches jobs and they're variable, you're dead in the water until you hit the 2-year mark because we have to do an average. That's a Fannie Freddie requirement and an FHA requirement.
So it's only really like unpredictable, like getting a promotion.
If you get a promotion, that's fine. If you get a promotion, that's fine. Or if you do a step up, that's fine. If your salary increases, great. If your salary is going to decrease for whatever reason, you just have to make sure that your DTI stays in line for your purchase price range.
Is it like tricky because like I'm a 10-month employee or the school system, so the summer's on?
You can still do it. We average you for 12 months. And then if you have the thing is that any seasonal workers, if you are a 10-month employee or a seasonal worker and you do receive unemployment, not in your case because you're a teacher, but like your landscapers and any of that, and they do receive unemployment and you have proof of their unemployment for 2 years, that's qualifiable income. So you can use the unemployment and you can use their regular 10-month. For teachers though, we average you 12 months. Any part-time job, 2 years. You need to be at the part-time job for 2 years to use the income.
Am I right, or with a USDA loan, you can only have one building? Because you can't rent,
They don't, it's a single family, yeah. USDA is single family primary residence only. FHA will do a multi-unit, but FHA will only allow you to have it used to be, FHA had a really great guideline, and it was like awesome. Hey, I bought a multi-unit, but I want to move school districts, and I want to go into a better school district. I want to keep my FHA multifamily and go into a single family. Well, think about it on the whole school district issue. So they would allow 2 FHAs. You have kids, tell me the age of the kids, you verify all of it. FHA put an end to that. So the only way you can do 2 FHAs, same is if 100 miles apart, and they actually make us Google and do the whole maps. VA, they will tell you that you can have 2 VA loans at one time. You can, but you have to just make sure there's a calculation for your VA benefit because you get your VA benefit and it's going to tell us how much you can use. Yeah.
So with the USDA, you mentioned if you have children, then their income.
If they're working, yep.
I was just curious with things like that, or any of those things where they monitor stuff. Is that the term of the loan, like the term of the loan, or is that up until you're getting like you close and now have gotten the loan?
That we're monitoring
Yeah, like,
income?
let's say, like, you know, my son is in 4 years starts making income, and now, like, that's not.
No. For USDA guarantee, once you close, I don't care what you do with your job. Like, I don't care what you do with your job. But the USDA direct, you have to upload your income from my understanding, I don't originate the direct, but I do know, I think you have to upload your income every year to them. Yeah.
That's just interesting, because, like, if you somehow get a windfall, because it's like a low income.
It's low income, but the other thing is to be mindful that USDA, if a borrower has a lot of money in the bank, you're not going USDA, they won't allow it.
But I'm saying if you didn't, when you got it, and then, I don't know.
I believe when you sign the note for them, they are going to walk you through what happens and then what happens to your loan and your interest rate if something changes.
As far as money in the bank, when you're looking at that, does it matter if it's personal or it's a business account?
Can be either, but if there is a guideline out there that if it's a business account and you're using it, depends on the underwriter that you get. Sometimes they're going to make sure that it doesn't, if it's a business account, it's not going to impact your business, right? Yeah. But there used to be, and accountants don't allow this anymore. The way around that was, we used to get a letter from an accountant that would say, hey, I do his books, or I'm his accountant. Taking $10,000 from the business account will not adversely affect. Then accountants said, I'm not writing that letter. I absolutely will not write that letter. And it puts them at risk. There are ways around it. But the other thing is, if you were my client, I would probably argue this. They do have the right on a business account to look at the deposits going in. So they might ask you for your invoices. I have a tendency to challenge my underwriters on that. I challenge my underwriters. I argue with people on a daily basis, but I'll be like, do we really need that? Blah, 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 blah. Like, you're well within your right too, as borrowers, to say, show me the guideline. You can say that. Real estate agents can say it too. Where's the guideline on that? Or you know, the other thing is too, not to keep this too long for you. This is just a general kind of overview of mortgage lending. Every lending institution has something called overlays. It's called banking overlays. So for instance, if you go to the Bank of Greene County, they're 10% down, conventional loan, 20-year term. That's their overlay. That's what they're offering. So sometimes when I get a file, and you know, do I know every guideline? No. I mean, every once in a while an underwriter will send me something, I'm like, when did they change that? Guidelines change all the time. What I will do sometimes is, if something happens or there's a borrower and hey, the underwriter is, I'm not approving it, or I want X, Y, Z. Wording that Caitlin and I use is that a Fannie Freddie guideline or a guaranteed rate overlay? If it's an overlay, sure as shooting, I'm challenging that. I'm going right to the head underwriter. I mean, I go to underwriters all the time. I'm like, what are you doing? We're not doing that. But so it's called agency, Fannie and Freddie. Is it an agency guideline? And I'll even take it a step further and say, show me the guideline. The other thing is too, with guideline, think about it. It's open to a matter of interpretation. So like one underwriter, especially FHA, I love her. I called her, I'm like, hey, I have this file. I have a tendency to take the really hard files because people know I will advocate. I argue that thing I argue it until like I'm blue in the face. Like sometimes I'll say, Caitlin, I'm exhausted, I've argued this. But if I can find a workaround, I'm going to find a workaround. But even then, like sometimes I'll say to my favorite FHA underwriter, I'm like, if I send you this file, are you viewing it the way that I'm viewing it? And she said, another underwriter might say no, but I agree with your findings, send me the file. So what you really want, the whole point of this is you want to find an originator that's really going to advocate for you, but at the same time is going to walk you through it. So, yeah. You're welcome.
You mentioned assets. I mean, there's some difference between what constitutes an asset from a mortgage perspective.
Asset is bank statement, 401k, any investment accounts. Life insurance, not really. but that's really your assets. 401k, bank statements, investments, stocks. You good? Thanks for coming.
Oh,